This is the third of a 3-video series on financial to-dos after a spouse passes away. In the first video, we covered near-term actions. In the second, intermediate-term actions. In this one, we're doing a deep dive into creating a financial snapshot. This financial snapshot is critical for 2 reasons. One is it will feed into a financial plan to help the surviving spouse determine if she can afford her financial goals, and if not, what adjustments she needs to make. But it will also inform the process of settling the deceased spouse's estate, basically moving assets that were in the deceased spouse's name to the new owners. My name's Rick Wechter. I'm the founder of Old Peak Finance. We're a comprehensive financial planning firm based in Chapel Hill, North Carolina, and working with clients nationwide. We've worked with a number of folks who've gone through exactly this process. Let's get into the financial snapshot. This is a sheet that you should try to create within the first month or 2 after your spouse has passed away. It lists, on going left to right, the kind of asset or liability, the legal owner, the location, the approximate value, and the beneficiary information, basically who becomes the owner after the owner's passing. All right, let's go down line by line. Start with bank account. In this case, a joint bank account. As most bank accounts are, this is owned joint tenant with right of survivorship. So that means that there's no court process. This automatically becomes the survivor's sole account. At some stage, in this case, Barb will want to go to Wells Fargo, provide a original copy of the death certificate to claim sole ownership, but there is no legal process involved. All right, the next asset is Dennis's brokerage account. Here we're assuming it was owned in a trust that Dennis had created, very common, at Schwab in the amount of $1 million. Here, because the account was owned by the trust, you simply look to the language in the trust as to who becomes the new owner of that asset. It might be Barb. It might be a trust owned by Barb. Could even be the kids, but typically it would be either Barb or a trust owned by Barb. You would provide the trust document, in this case to Schwab, and they would then transfer the assets to the new owner. Okay, let's go down to Dennis's 401k and below Dennis's Roth IRA. Here we've assumed in both cases, and this is typical, is that Dennis named his spouse as the primary, 100% primary beneficiary, that's on the far right, and the kids as the contingent beneficiaries, meaning they would have inherited if Barb were deceased. In the case of a retirement account, the beneficiary will simply provide the death certificate to Fidelity or Schwab, and they will transfer the ownership of the assets into either a inherited IRA that Barb has, or in the case of the Roth, it would go into an inherited Roth IRA, or it could just go into an existing retirement account that Barb has. But this is all based on the beneficiary instructions that Dennis set up in the retirement plan. That's different again from Dennis's term life policy. We're assuming that his trust owned a $2 million insurance policy on his life at Transamerica. To claim this benefit, Barb will provide a death certificate to Transamerica, and they will write the check out to, in this case, Barb's trust, because she was the legal beneficiary. Next one is primary home, whereas we've assumed here, as is very often the case, that the home was owned jointly in a legal form called tenancy by the entirety, which is a form of joint ownership that only married spouses can use. In this legal form of ownership, Barb automatically becomes the sole owner. There's no reason to go through a court process. Sooner or later, she'll again want to go to the land registry to retitle the house in her name, but that's something she doesn't need to do really until she ends up selling the house. She becomes automatically the sole owner. Cars are a different situation and can sometimes be problematic. It's quite possible, here we've assumed that Dennis owned his car in his name, so it will technically have to go through a legal probate process unless he named a beneficiary for the car's ownership. If the value of the car in Dennis's estate was small enough, you don't have to go through a formal probate process. It can be an expedited one, but still may well require some sort of expedited court process. Personal possessions is the same unless in a trust they were assigned to a trust, in which case it wouldn't have to go through probate. Again, if these are nominal, you may not have a difficult process, but technically it should go through the probate process. And then let's look at the liabilities. I've listed 2 common liabilities here, mortgages and credit card. We're assuming for a moment that Dennis put the mortgage solely in his name, which might be because he had the primary income and just it was from a paperwork perspective at the time, easier just for him to fill out the mortgage application rather than both of them. Fortunately, there's a federal regulation that requires the lender to move the mortgage to Barb's name without her having to qualify that she can afford the mortgage or make the payments. So it automatically goes over to her name. Again, you'd need to provide a death certificate. And then the credit cards, you'll want to contact the credit card companies and provide them with the death certificate. The easiest thing is just to pay off any debts. But Barb is not technically obligated to pay for debts on Dennis's credit card, but his estate is. So if they hadn't been paid off, then the estate would have to make the payment of any credit card balance before the estate could be settled. So always good just to clear out that credit card balance and close the account. I hope that example of a financial snapshot is useful. It should be created within the first month or two after the spouse has passed away. If you have further questions, please reach out and good luck.